Hello guys. Financial statements represent a formal record of financial activities of an entity. These are written reports that quantify financial strength, performance, and liquidity of a company. Financial statements reflect financial effect of business transaction and events on the entity. Let's now discuss in brief four statements that constitute financial statements. First of all, income statement. Income statement, also known as profit and loss account, reports the company's financial performance in terms of net profit or loss over a specified period. Income statement is composed of following two elements: income, what a business has earned over the period; expense, the cost incurred by business over a period. Example: salaries and wages, depreciation, rental charges, etc. Net profit or loss is arrived by deducting expenses from income. Next we have balance sheet. Statement of financial position, also known as balance sheet, represent financial position of an entity at a given date. It is comprised of following three elements: asset, something a business owns or control, that is cash, inventory, plant and machinery, etc. Liabilities, something a business owes to someone like creditor, bank loan, etc. Equity, what business owes to its owner. This represents the amount of capital that remains in the business after its assets are used to pay off its outstanding liability. Equity therefore represents the difference between assets and liabilities. Cash flow statement. Cash flow statement represent the movement in cash and bank balances over a period. The movement in cash flow is classified into following segments. Operating activities represent the cash flow from primary activities of business. Investing activities represent cash flow from purchase and sale of asset other than inventory. Financing activities represent cash flow generated or spent on raising and repaying share capital and debt together with payment of interest and dividend. Statement of changes in equity, also known as statement of retained earning, details the movement in owner's equity over a period. The movement in owner's equity is derived from following components: net profit or loss during the period, share capital issued or repaid, dividend payments, gain or losses recognized directly in equity, effects of changes in accounting policy or correction of accounting error. Let's now go through formats of financial statement to understand the finer details. First of all, income statement. Income statement comprises of following main element: revenue. It includes income earned from principal activities of an entity. So for example, in case of manufacturer of electronic appliances, revenue will comprise of sale from electronic appliances business. Cost of goods sold represent cost of goods sold or service rendered during an accounting period. Deducting COGS from revenue, we get gross profit. Deducting employee salary cost and any expenses on selling, marketing, distribution, office, general and admin expenses, we get EBITDA or operating income. We now provide deduction for depreciation or amortization of fixed asset due to wear and tear and obsolescence in normal course of business, and we get EBIT. Financial charges usually comprises of interest expenses on loan, and all indirect income and expenses are adjusted here, and we get earning before tax. We provide provision for tax and adjust for non-recurring prior period and extraordinary expenses, and we finally get net profit for the period. Moving on to balance sheet, it has two parts: equity and liabilities and asset. The sum total of both the side is equal. Equity is what business owes to its owner. It represents the residual interest in the business that belongs to the owner. Shareholder funds comprises of share capital and reserve and surplus. Then we have share application money pending allotment. Liabilities are comprise of non-current liabilities and current liabilities. Current liabilities are those liabilities which are expected to be settled within 1 year, and non-current liabilities are long-term in nature. Non-current liabilities may be long-term borrowing, deferred tax liability, etc. Current liabilities can be short-term borrowing, trade payables for goods purchased, provisions, etc. Next we have assets. Assets are also comprised of two parts: non-current assets and current assets. Non-current assets are long-term assets that a company expects to hold over one fiscal year and that cannot be readily converted into cash within a year. Current assets are expected to be converted into cash within a year. Non-current assets can be property, plant and equipment, intangible assets, non-current investment and loan and advances, deferred tax asset. Current assets can be current investments, inventory, trade receivable from goods sold, and cash and equivalent. Next we have cash flow statement. It has three sections. First of all, cash flow from operating activity. We start from profit before tax and we adjust for non-cash expenses like depreciation, amortization expenses, and non-operating expenses like interest expenses, etc. Now we get CFO before working capital changes. We adjust for increase or decrease in current assets and liability, and we get CFO before tax. After deducting tax paid, we get cash flow from operation. Moving on to cash flow from investing activity, we show capex, purchase of investment, interest and dividend income, disposable of fixed asset investment, etc., and we get CFI. Cash flow from financing activities, major components are issuance of share capital, bank loan received, repayment of bank loan, interest and dividend payment, and we get cash flow from financing. Adding all the three components, we get net increase in cash and cash equivalent. Adding opening cash and equivalent, we finally get closing cash and equivalent. Thank you.